Welcome to Chapter 9, Module 2. We're going to wrap up flexible budgets with this module. Uh-oh, looks like Larry and his tractor are getting ready to join us. First up, let's prepare a report showing revenue and spending variances.
A revenue variance is the difference between what the total revenue should have been given the actual level of activity for the period and the actual total revenue.
A spending variance is the difference between how much a cost should have been given the actual level of activity and how much the actual amount of the cost is. Now let's calculate the revenue and spending variances for Larry's lawn service. In your course pack, use the template in Chapter 9 Case Study Part D to complete the flexible budget and variances for Larry's lawn service. Use the same flexible budget you constructed in Part C, just drop the numbers into Part D in the column Flexible Budget. Then calculate the variances by taking the difference between the flexible budget and actual results.
Remember, these are called the revenue and spending variances.
Pause the video and take a few minutes to complete the template. Compare your answers to this slide. The $1,750 favorable revenue variance indicates that actual revenue exceeded the budgeted amount that was expected for that level of activity of 550 lawns mowed. This could have happened for a number of reasons, including an increase in the amount charged for each lawn or a change in the lawn services. In Larry's case, he trimmed some hedges, which increased revenue.
That hedge trimming may have also caused some of his costs to be unfavorable.
You bet. By comparing actual results to the flexible budget, we're comparing the budget at actual activity levels to the actual results, or apples to apples. Take a look at the spending variances. Pay particular attention to make sure you got the favorables and unfavorables correct. Remember that for expenses, if actual expenses are greater than the flexible budget, it's unfavorable. We wouldn't want more expenses, and if actual expenses are less than the flexible budget, then it's favorable, because we would want less expenses. Let's look at a report that combines the activity and spending variances together in one report. Here we see the flexible budget performance report that shows both activity variances and revenue and spending variances. Note that the activity variances appear between the planning budget and the flexible budget, and that the revenue and spending variances appear between the flexible budget and the actual results. By the way, here comes Larry.
Oh, isn't he cute? Wait, was that a John Deere?
Whatever. Our variance analysis or performance report can easily be prepared for a cost center. We prepare it the same way, except cost centers don't have revenue or net income, so there would be no variance comparison for those items. Let's look at a flexible budget with more than one cost driver. It's unlikely that all variable costs within a company are driven by a single factor, such as a number of units produced, labor hours or machine hours, or lawns mowed in the case of Larry's lawn service.
More than one cost driver may be needed to adequately explain all of the costs in an organization. The cost formulas used to prepare a flexible budget can be adjusted to recognize multiple cost drivers.
Because of the large unfavorable wages and salary spending variance, Larry decided to add an additional cost driver for wages and salaries. The variance is due primarily to the number of hours required for additional edging and trimming. So Larry estimates the additional hours and builds those hours into both his revenue and expense budget formula. The new revenue formula is $75 times the number of lawns, which is Q, plus $25 per hour spent on edging and trimming, which is H. The new cost formula for wages and salaries is $5,000 plus $29 per lawn plus $25 per hour spent edging and trimming. As you can see, the flexible budget is based on mowing 550 lawns with 100 hours spent edging and trimming.
The new flexible budget, based on both the number of lawns and the additional hours for edging and trimming, is used exactly like the original flexible budget that was based on number of lawns. The new flexible budget should result in more accurate budgets and variances.
Let's talk about some common errors made in preparing performance reports based on budgets and actual results. The most common errors when preparing performance reports are to implicitly assume that all costs are fixed or that all costs are variable. First common error is to assume that all costs are fixed. When we compare actual results at one level of activity with a static planning budget at another level of activity, without any adjustment for activity change, we're implicitly assuming that the costs are all fixed.
Comparing static planning budget cost to actual cost only makes sense if the cost is fixed. If the cost isn't fixed, it needs to be adjusted for any change in activity that occurs during the period.
Assuming all costs are fixed gives you variances that are meaningless. You can't tell whether a company was managed well or not. The second common error is to compare actual results to the dollar amounts in the planning budget multiplied by the percentage increase in activity level. This approach assumes that all costs are variable with respect to changes in activity level.
Although changing the planning budget by the percentage increase in activity is a valid adjustment to make if an item is strictly variable, gasoline and supplies and equipment maintenance, this doesn't make sense for fixed cost. Fixed costs in the planning budget should not be flexed to accommodate the actual level of activity.
This approach also ends up with variances that are meaningless. That's all for Chapter 9. Larry wants to know if you think his tractor's sexy.
About as sexy as managerial accounting.
Now that's sexy. See you soon.